All right, let's get to Michael Harris, who is the founder of Cribstone Strategic Macro, who joins us now. Michael, you've asked the intriguing question a lot of people are asking, bond or equity markets, which one is wrong? But I wonder if they're both right in terms of the equity markets see that they can still make hay while the tapering, basically, even if it starts, is going to take the best part of a year. And in terms of the bond market, so many people are forced into this market as well for their risk profiles that actually they don't have any choice.
Yeah, well, I think if they don't have any choice and that's the reason they're in the bond market, it could still be a justification for why the bond market is ultimately making a mistake. But I think we're at the stage, for a long time, the bond market obviously loves all the QE and the stimulus. That's fine. The bond trade has been very, very clear. But at the same time, the equity market has liked it because they thought the stimulus is enough. It allows for re-rating. Obviously, if equities are valued relative to bonds, they're worth more when bonds are as aggressively priced as they are right now. However, that all happens in a period where the stimulus is meant to have a positive impact. And the market is anticipating that. I mean, we saw the quarterly results were huge and the profit margin. So in essence, that recovery means that both have been right effectively for the time being. But now, if Jay Powell's added caution in Jackson Hole, which I think is the way you have to present it, because in June he was very clear that the U.S. job market is definitively extremely strong, and now there's a little bit of wavering because of vaccine efficacy. And that's obviously something that everyone's focused on. But what I would stress is that historic view that stimulus is good for equity markets isn't the case right now, because if Jay Powell's caution is correct and vaccines don't have the impact on reopening, and with inflation already where we are, then the likelihood, if bond markets are right here, in the next few months we're going to find out that equity markets are wrong. Or vice versa. If we get that recovery coming through and that caution fades and we do start to see some tapering, then clearly we're in a stage where that forced buying of bonds means you were making a mistake. You were just buying because you had to, but clearly the bond trade is over if the tapering is now going to begin, let's say in November. So my guess is one of these asset classes is going to definitively outperform the other to year end. The hope is it's equities for everyone, because that means the recovery is working. But if this vaccine efficacy is problematic and the reopening trade fades, then we're in a very ugly space, because we've got all the stimulus we've had with the problem of the inflation we already have at this stage. So I think one way or another, the markets are not going to be particularly calm through the remainder of the year.